What's going on, everyone? Welcome back to another video and part 3 of everything you need to know to get started trading market structure. So in the first video we covered how to identify market structure and when it breaks. In the second video we focused on dropping down to lower time frames once we notice market structure does break, and looking for places that we can start placing our entries, as well as finding things that coincide and add confluence to what we've already seen on the higher time frames. So in this video we're going to be focusing on our risk management. Where can we place our stop loss, where can we place our take profit, as well as what pairs should I be trading and when should I be trading them. So let's go ahead and look at this example that we have from Euro USD from the previous video, and let's kind of start diving into that. So as we know, we had multiple opportunities to get in on this trade. Once market structure broke, we had this double bottom right here. We had two double bottoms over here. And then we have this head and shoulders right here. So we have 4 opportunities to enter the market, and they all have their own retest areas off the neckline. So now that we understand these are the general areas where we're looking for our entries, where do we place our stop loss and where are we going to place our take profit? And there is a few ways that you can do it, and we'll just go over them and then you can decide what fits your trading style best. So with this right here, where I would place my stop loss would be the most relevant low. And since we're on the 5-minute, I would do the most relevant low for this. So if my entry is here, this is the pattern I'm basing it off of, my stop loss would go roughly in this area. This is the most relevant low from this pattern. Now you can also do this by going to the 1 hour and doing the most relevant low there. So let's go ahead and look at the 1 hour and let's see what is the most relevant low from our entry. So as we can see, our first option would be right here where we have this little level of support, and your second option would be down here. But since we're on the 5-minute, I always like to use the low for the 5-minute just because it pulls me out of my trade faster and gives me a tighter stop loss, so I lose less money if the trade goes against me. So I would put mine right here just because it's the most relevant low. Now you're probably asking yourself, well, where would I place my take profit? And that would be the opposite of what you did for your stop loss, which would be the most relevant high. So we have this relevant high here. Oops, let me go ahead and place that. What's going on here? Right here, there we go. We'd also have this what is going on, general area right here, and you can do that off the 1 hour as well if you want to. So let's just go ahead and look. So there you go, you have your stop loss. Now you have take profit 1 because this is a relevant high, and then this is also a relevant high, so this would be take profit 1, this would be take profit 2. So you're risking roughly 14 pips to make roughly 75 pips. That's a really great trade. That's almost like 5.5, I think, to 1. Or yeah, it's a 5 to 1 trade. That's really good. Now if you decided to place your stop loss at this low down here, then obviously your risk to reward would be a little bit different, as we're always going to risk a certain percentage of our account per trade. So now you drop that trade down to a 3 to 5, but that is still a really good trade. As long as it is a 1 to 1 or higher, it's a good trade. If you ever have a negative risk to reward ratio, just don't take that trade at all. So let's go ahead and let's look at our other trade opportunities so you guys can get a little more examples. So let's go ahead and look at these next two, which will be roughly the same just because they're in the same area. So let's say we entered this trade right here. Here is our pattern, the bottom of that. Where is the next most relevant low based off the 5-minute time frame that we're on? We have this one right here. So let's go ahead and drop that down there. And then let's go ahead and put this right here, our first take profit opportunity. And this would be a 6 to 1 trade. Very good. If you take it to your second trade opportunity or take profit opportunity, now you have a almost 11 to 1. And this is a rare occurrence. It doesn't always play out that way. But let's say you wanted a stop loss that was a little bit bigger to let the market breathe more. Where would be the next most relevant stop loss based on the 5-minute? So if we went based off this, it would be down here on this pattern. So now we drop this down to here, and now you went from a almost 11 to 1 to a 3.5 to 1, which is still a really good trade. And if you want to do the same thing you did with the last trade and take your stop loss based off the hour, then you can go ahead and drop that down there as well. And now you have a 2 to 1, still a really good trade. This one is going to end up being the exact same. Only difference is the stop losses, or excuse me, the entry a little bit lower, so your risk to reward ratio is going to be slightly smaller. And then for this one, it is the exact same. If we enter our trade right here in this rough area, first take profit, most relevant low, which would be right here. Take profit here. So this is a 2.5 to 1 or a, sure that's all good, almost a 5 to 1. Now, once again, you can go and drop to another relevant low, like maybe here, or you can go based off the hour, which would be down here. And this is a 1.5 to 1. So all of these are viable trades based off of what we've seen. Okay, so these are all very good trades. So now that you kind of understand where am I going to place my stop loss, where am I placing my take profit, how is this going to affect my risk to reward, we can focus on what pairs should I be trading and when should I be trading them. And this is totally dependent on you, because we all have different lifestyles. We have all different kinds of obligations. So what you need to do is look at these sessions and figure out, when do I have on an average daily basis the most free time to myself to be able to look at the charts, study them, and place my trades. Obviously, most people are at work from 8 a.m. to 5 p.m. So maybe New York session isn't a good time for you to trade. So maybe don't trade USD based pairs, right? Maybe you have more free time between 5 p.m. and 2 a.m., 7 p.m. and 4 a.m., or 3 a.m. and 12 p.m., right? And this is all based off EST, Eastern timing. But you need to go through and figure out on a daily basis, when do I have the most free time to myself that I can consistently be on the charts and look at these pairs. If it's the Sydney and Tokyo market, then focus on Australian pairs and Tokyo pairs like the yen. If it's London, focus on European pairs like GBP, the euro, the Swiss franc, things like that, right? And then trade those pairs within the sessions that they correspond with, right? Because that's when they're going to make the most movement or have the most volume in them, so you can get in and out of your trades quickly, so you have less time to think about your trade and let your mentality or your psychology psych you out of your trade and have you make beginner mistakes. So hopefully this has been helpful. Hopefully you guys learned something. Hopefully this cleared things up and you guys have everything you need to start trading market structure. If you guys have any questions, you're confused over anything, or want more examples, just drop a comment below and I'll be more than happy to help you out. With that being said, I'll catch y'all in the next one.